It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. Thank you so much for being with us. With me in the KFG studios, my business partners and friends and fellow CFPs, Kevin Korhorn and Josh Gregory.
Yeah, we love the Roth IRA. It's a tool, and we are fans of having as many different tools on your tool belt as you can. So we've been thrilled to see the Roth 401k become prevalent in the last 5 years or so. Now, the interesting thing about that, there is a trap that can impact your Roth 401k when you go to withdraw money in retirement. Most people don't know about it. Even as a financial advisor, you might find this a little shocking. So we're going to talk to you about that today and get to some listener questions.
All right. If you have any questions for us, especially, today's content is going to start a little heady. If you have any questions, reach out to us. You can do so a few different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyradio.com. You can also check out the blog right there, wisemoneyblog.com as well. But you can submit questions right there on the website and catch up on previous episodes. And then all over social media as well. Just search Wise Money Show, Facebook, YouTube, and Twitter. And I'd encourage you, stay engaged with that content and subscribe to it, like it, and share it, all that sort of stuff. So as we come out with further announcements or blog stuff, different content, that it's always going directly to you and you can stay on top of it. All right, I'm going to chalk this one up to, if you're not doing comprehensive financial planning, even like Kevin said, if you're not working with a financial professional who is always trying to sharpen the saw, you would never know about this stuff. The U.S. tax code is one of the most complicated tax systems in the world. And I have felt that, but I was actually doing some research for this, and the authors stated that. The U.S. tax code is one of the most complicated in the world. And it's full of rules and then exceptions to the exceptions and so on. And that's why you need a CFP helping you with your financial planning. Well, Matt Hoke on our team, one of our CFPs, I think he's been on the show before. Has he? I believe he has. Once, twice. Maybe we need to get him on here. But he was doing some research helping someone that had a significant amount of money in their Roth 401k and was getting ready to withdraw the money. And he said, we need to double check something here. And came across a tax trap that essentially no one knows about. So let's dive in from there. What is it? How does it work? What's going on?
Well, the 5-year rule for the Roth IRA distribution, it relates to distributions, and it stipulates that 5 years must have passed since the tax year of your first Roth IRA contribution before you can withdraw the earnings in the account tax-free.
Yeah, okay. I feel like maybe we need to confess our contribution to the misunderstanding, because whenever we talk about Roth IRAs, we always sing the praises of how great this tool is, that if you set aside money into a Roth IRA and let it grow for the future, you won't pay tax on the gains, which is wonderful. And we often cite the age 59 and a half. If you keep the money in the account until age 59 and a half, you can start taking withdrawals and spend it in retirement. No taxes, no penalties. But there's actually an add-on to that rule that no one ever mentions.
Yeah.
Right? It's not just you've got to get to age 59 and a half. You have to be at age 59 and a half, and the account has to have been open for 5 years to avoid the penalties on distributions.
Even that, though, is simple, but I think the rule is even more complicated than that. You have to have an IRA open.
Roth IRA.
Yeah. Open for at least 5 years. Not just this specific account. You could open a Roth IRA right now, wait for 5 years, and then you're done. You've met that test. It doesn't need to be that specific account. So yes, it is confusing. We often do cite the simplified version because you'd expect that you'd have a Roth IRA open for at least 5 years. But as we even pull back the layers of this onion even more, you're going to realize, I better get that done.
Well, we're often talking about Roth IRA being so powerful for young people. If you're at the beginning of your career and you have literally decades that you could be contributing to this account, it's so powerful that growth can accumulate without ever being taxed. So, of course, if you've got decades, then you're going to more than satisfy the 5-year rule. But the Roth IRA can be an amazing tool for those who are approaching the end of their career as well. And you want to really have this on your radar screen, something that you're considering beginning to use within 5 years of your preferred retirement date.
All right, so here's the wrinkle. You guys thought that was the wrinkle. Here's the wrinkle. Everything that Josh just said, Kevin just said, that's the Roth IRA. Surely, if you have a Roth 401k and you're putting money into the Roth 401k, then you meet that 5-year rule, right? Let me give you an example. You start working and you're saving into that Roth 401k, Roth 401k, Roth 401k, and then you are ready to retire. And you roll, just like I think 99 people out of 100, you roll that money from your 401k over to your IRA. So you move your Roth 401k to a Roth IRA, start pulling money out. Nope, you have not had a Roth IRA for 5 years.
Exactly. And even that concept that most people do not leave the money in their 401k at work when they retire. It is, there's all kinds of reasons for why people would roll money over to an IRA. They have more flexibility on the investments, easier method of taking those distributions and everything. But as you just said, when you do a rollover from a Roth 401k to a Roth IRA, you're beginning potentially a new 5-year period of time. And you may not want to be waiting 5 years to start taking those distributions. You may be subjecting yourself to unnecessary penalties because you just didn't realize that this trap existed.
So there are ways, and the only thing that I would add, the other wrinkle, when you think about this with a Roth IRA, if I put money in, let's call that my basis, I can withdraw my basis at any time totally tax-free because I put after-tax money in, so I pull it out tax-free. It's the earnings that we are concerned about. Mm-hmm. So when you look at this, people say, well, can I use the Roth IRA as this tool? This is a great tool. Can I use it? There are some income constraints on whether or not I can use it. And so there are, not everyone necessarily qualifies to do a Roth IRA. So you really, again, Mike says, work with a financial planner. Make sure they're certified. Make sure they work in the 6 areas of CFP and they've got a good handle on the tax planning, but also this technical side of it, because there are lots of different ways to do it. I think of the situation with the client who's an incredibly high income. They don't qualify to make a contribution to a Roth IRA, but they've got the Roth IRA in their 401k. So they don't have a Roth IRA outside. And you say, well, start one. Mm-hmm. Well, if you can't contribute to a Roth IRA outside, how do you start it? Well, there's lots of kind of creative ways to do it. One way to do it is to look at your plan and see, can I do an in-service withdrawal? Mm-hmm. Can I roll money out of my plan and get that clock started ticking?
Well, I mean, so what's the prevention mechanism here? And the prevention mechanism is to start that 5-year clock right now for your Roth IRA. If you don't have a Roth IRA, even if you've looked and said, you know what, I actually am working with a certified financial planner and we're doing comprehensive financial planning, so I'm good and I'm funding everything pre-tax, I would take $50 and put it into a Roth IRA. If you're allowed to, if you're eligible, which hopefully you are, I would at least get $50 into that Roth IRA so you get that account open and start that 5-year rule.
And if you're not sure whether or not you are eligible for a Roth 401k, not every 401k plan out there has added this relatively new feature. It's something that your employer has to build into the plan for you at work. But if you're not sure, then it may be one of your best action items come Monday morning to contact your human resource manager, contact your supervisor, find out whether or not this feature is available and whether or not you should maybe begin considering using it moving forward.
I mean, yeah, that's the thing. The takeaway here is not avoid this Roth 401k and avoid Roth IRAs because this 5-year rule is confusing. These guys tried to explain it and they didn't do a great job. So no, it's not to avoid it. It's actually to use it, but then be aware of these rules and so on. We're actually going to spend a couple minutes then talking about, well, hey, here are some clear-cut examples and circumstances where you would want to use the Roth IRA and 401k, and then even a couple where you might not want to. So we've got a lot more to come here on Wise Money with Korhorn Financial Group. All right, let's pick it back up. We'll talk about, hey, when really should you consider using the Roth IRA and 401k, and a couple honorable mentions for when you shouldn't. Good? Is the Roth 401k such a great tool, or are there some tax traps that you need to be aware of before jumping headlong into it? Actually, we shared a tax trap that was, quite alarming. Not a lot of people know it. And we're going to talk a little bit more about that in just a few moments. Thanks for being with us. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to the attorneys at Ledoux, Kern, and Keene, now South Bank Legal, as well as First State Bank for sponsoring the content of today's show. Thank you very much. In a few moments, we're going to be getting to your questions. Thanks for submitting them, and thanks for your patience. If you have questions, give us a call, send us a text, 574-222-2000. That's 574-222-2000. Online, wisemoneyradio.com, and then social media, just search Wise Money Show, YouTube, Facebook, Twitter, and subscribe to it and so on so that you get all of that content and never miss a thing. Okay, so we were sharing that there is this unique 5-year rule when it comes to withdrawing dollars from your Roth IRA, and there's even a 5-year rule when you're doing withdrawing dollars from Roth conversions, which maybe that's a whole nother show. This gets really, really technical. And it turns out that this obscure 5-year rule is not immediately, for a Roth IRA, is not satisfied by a Roth 401k. So you've got to make sure that you open up a Roth IRA, even if you just put $25 in or $50 in it. You've got to be eligible, but get that thing open, because really all you need is a Roth IRA open for at least 5 years, and then you're good. You're good with this rule forever. And so get that started now. So with all these complexities and concerns, is the message that you shouldn't be using a Roth 401k or Roth IRA? No, absolutely not. You just need to have a Sherpa. You need to have a guide. Let's talk about some circumstances, some very clear ones. Don't make these decisions in a vacuum outside of the context of all 6 areas of your financial life. But what are some circumstances where you definitely say you got to consider the Roth 401k? You should be using it.
And before we do that, can I just add?
I knew you were going there.
I
knew I
can't help it. Because I'm thinking about the person listening right now saying, okay, so it sounds like I have a choice between doing a Roth IRA and a Roth 401k. That is actually not your choice. You have, think of this, you have a coupon every year. You can put in the 2019 limits, or you can do an IRA. You can do an IRA or a Roth IRA. And you can put $6,000 in. If you're 50 plus, you can add another $1,000 to that. So your IRA/Roth IRA limits for 2019 are $7,000. And then in addition to that, if you work for an employer and they have a retirement plan, you can just, I'm going to keep it simple and say it's a 401k. You can put $19,000 in that. And you can do those as traditional contributions, or you can do those as Roth contributions. If you're 50 plus, you can do another $6,000. So numbers don't work very well on the radio. Just think, my IRA, I can put $6,000 to $7,000 in. My 401k, I can put $19,000 to $25,000 in. And yes, you can do both of those. And yes, in spite of income limits with a little creativity, if your situation allows for it, and most people's does, you can actually fund a Roth IRA if you exceed the income limits.
Yeah, it's amazing when you think back over the past 10 or 15 years how big the contribution limits have gotten on these retirement plans.
It's $2,000, right?
I think the government has recognized that there's a retirement crisis in this country. People are not prepared. They don't have enough saved. And so we've been given the opportunity to set aside more money than ever into these tax-advantaged accounts. And we've been highlighting the Roth IRA today and the Roth 401k because of some of the unique features that they have, but there's some traps that we were unpacking in the prior segment. I think when I think of a Roth account, either type, Roth 401k or Roth IRA, my mind naturally goes to younger people. Because the longer that you can use this tool, the longer that the money can be out of the reach of the government and growing in some sort of investment portfolio that you've built, tax-free. It is just amazing. And to me, the power is in the length of time that you have the money set aside. By way of an analogy, if I were to give you a pair of round-trip first-class tickets to anywhere in the world, okay, you can fly anywhere from any airport to any other airport and back again, you would probably pick some sort of long flight. Like you're probably thinking Hawaii or Fiji or Australia, somewhere far away. You're not going to use those tickets to fly from South Bend to Detroit, right? Chicago, even shorter, right? So the value of those free tickets that I gave you is in being able to enjoy the flight in a better setting than you would have in coach, right?
Never enjoyed a flight.
Never,
just
because you've
personally
never
speaking.
flown first class, Mike. Neither have I, actually. I'm just imagining what the people at the front of the plane enjoy. But here's the thing: the longer you let your dollars fly for free, the longer that it stays in a Roth IRA, the more powerful it really becomes in your life. So think long. Think long on these dollars.
Great analogy, Josh. And we're talking about this 5-year rule. I mean, the benefit is on how long you have those dollars growing tax-free. So that is why when you talk about the Roth benefits, you rarely mention this 5-year rule because, you're going to have it for longer than 5 years. You want this money to grow tax-free.
Right. So think about this. What the practical application here is, if you have children or grandchildren that are working in the summer and maybe they made $1,200 for the entire year, and a lot of times people think, well, if my child or grandchild made $1,200 in the summer, they would have to put those particular dollars into a Roth IRA. Well, the reality is you could start up a Roth IRA for the benefit of your child or grandchild and put $1,000 in the plan, and now they're started. So a lot of times what we encourage clients to do is, if they have a couple extra bucks laying around and they're so inclined, to get that started for their children, grandchildren. It's never too early to get that Roth IRA started. But if you're in your 50s and you don't yet have one, it's time to get planning.
The other circumstance that I think of, so the first thought that you had, Josh, was age, and the second thought I had was tax bracket. Mm-hmm. A lot of times you got to move the needle as to pre-tax or Roth, depending on your current tax bracket. Now that's all changed, and I don't think the three of us are totally in agreement on this. It's certainly circumstantial, but what was 2 years ago, the tax rates, they're now a little bit lower. And so right now, the 24% tax bracket seems high because you got to get through the 10 and the 12 and the 22. And then the 24, that seems high. A couple years ago, you'd say, no, 24, that's better than 25. Mm-hmm. And so that's pretty low. And so knowing at what tax bracket for your situation you should be using Roth versus pre-tax, that is a crucial decision that is found at the kind of the intersection of all areas of your financial life.
Yeah, if you look at tax brackets today, it starts at 10%. Federally starts at 10%, goes 10, 12, 22. And I remember back in the day when the Roth IRA contribution limit was $2,000, and the tax brackets started at 15 and went to 28%. And for a married couple, it was at about 40,000. It went to 28%. So people were saying, well, hey, pay taxes on the money now and get it in your Roth IRA, because what do you know for sure is going to happen 20 years from now? 20 years from now, tax rates are probably going to be double. Well, here we are 20 years later, and they're half.
That's true, and we're adding to our debt about $1 trillion a year.
Right.
So
if you meant it back then, now we really mean it.
That's right.
It'll
Just
be
like
double.
just like interest rates, they will have to go up from here, right?
And we've been saying since 2006, interest rates are going up. Interest rates are going up. The broken clock is right twice a day.
So, but ultimately, you've got to make a decision based on your financial life. This isn't one where you're talking to your colleague at the water cooler and they're saying, well, I'm using a Roth. And you say, oh, well, I should be too, actually. That must be a good idea. It's got to be based on your financial plan and your specific situation. So we've got to talk about, well, other times when you definitely should not use a Roth. We've got that and your questions coming up here on Wise Money with Korhorn Financial Group. I don't think we should spend much more time on this, but maybe a circumstance or two. And then we'll get into questions.
And I have had a tickle in my throat. I keep thinking I'm going to cough right into this mic. Or worse. What? No, I'll be okay. But thank you.
All right. I have not looked at these questions.
Okay, so how long are we going to go on the Roth IRA then?
Just a couple minutes.
Yeah, 2 minutes.
Okay, so can we talk about when it's a bad idea?
Yeah,
That is the 2 minutes.
That's it.
Yeah.
But can we also talk about when you must?
We just did.
I know, but I got a little bit more.
I know we're
Okay,
not able to say
all right.
everything
Yeah, we should.
because we got to get.
Okay. Extra content for YouTube.
Oh.
There you go.
Okay, YouTube, here it is. I'm delivering taxes. We prepare 2,500 tax returns during tax season. I'm delivering taxes to a divorced single woman, and she worked at Notre Dame. I don't think you'll be able to identify her by that. But she worked at Notre Dame, and she comes in, and she's paying in federal taxes $0. And the person who helps her with her retirement plan through Notre Dame encouraged her to increase her contributions to the retirement plan, pre-tax.
Traditional contributions.
So she's paying no tax, and she's building up a tax liability to, at some point in time, pay taxes on.
At something higher than 0.
Yes.
Silly.
Or for her
Or her kids.
children.
Yeah.
So that's when...
That's a shame.
Lack of financial planning.
And
right?
there- and-
that is it.
And there are a lot of ministers in that situation
Yeah.
where they should not be doing pre-tax money.
Yeah. All right.
Because they have housing allowance, right?
Hey, we just started the recording.
Back it up.
All right.
Josh?
All right. How does it work if you are drawing Social Security and you want to work a little bit on the side, part-time? Does that mess with your Social Security? Does it? Are you penalized? We're going to talk about that. That was a great question texted in to us recently. This is Wise Money with Korhorn Financial Group. Thanks so much for being with us. My name is Mike Bernard, coming to you from the KFG studios with my friends and business partners, Kevin Korhorn and Josh Gregory. If you're watching on YouTube right now, Kevin's just flexing right there, saying yes. All right. Hey, thanks to Bethel University Adult and Graduate Studies, as well as Diane Bennett and her Inspired Homes team serving Indiana and Michigan. reach out to them if you have any needs. If you have any questions, we're going to jump into those in just a second. Couple of the first ones were texted in. You can text us 574-222-2000. That's 574-222-2000. And I'd encourage you, put your name and your age and maybe where you live at the beginning of that message so that we can identify it and ping it back to you. Online, wisemoneyradio.com, also wisemoneyblog.com to catch up on content that way. And then social media, just search Wise Money Show. YouTube, Facebook, Twitter, subscribe to it, and you'll get all the content delivered right to you there. We are wrapping up a kind of complicated discussion about the Roth IRA. The Roth IRA, great idea in a vacuum. It has some complexities to it, though. And so still, don't be concerned by don't shy away from the Roth IRA, Roth 401k because of these complexities. Just be using that in the context of your overall financial plan. There's just a couple of things we'd want to point out as to when you wouldn't want to use the Roth. There's another really big personality on the radio talking about finances who basically you listen to him and it's like the Roth IRA can do no wrong. You'd be an idiot not to use it, and he might call you that, actually. But it's based on your financial plan. So, guys, what's an area or two or a time or two when you'd say, no, I would not use the Roth?
A scenario may be if you are getting ready to send kids off to college, and the beauty of the Roth IRA is that it grows tax-free. However, when you make your contributions, it doesn't save you any taxes. It doesn't help lower your income, and maybe lowering your income using a traditional account could help you qualify for financial aid. So you need to pay attention not just to your tax picture, but maybe other areas of your financial life, like preparing for the college years.
I thought you were going to say there are some tax credits that are based off of your adjusted gross income, the number that used to be at the bottom of your first page of your tax return, but now I have no idea where it is. I have no idea. But some of the tax credits, especially these very valuable college credits, are based off of that adjusted gross income number. Your Roth contributions or your Roth 401k contributions do not reduce that number. And if you need to reduce that number to get some of these tax goodies, you should use pre-tax.
Well, and the other situation is if you're in a really high tax bracket today and you anticipate being in a lower tax bracket in the future. And as we said in the last segment, that used to be foolish talk, right? There's no way you're going to be in a lower tax bracket in retirement. No, actually, a lot of people, if you're a married couple, married filing jointly, you can have about $100,000 of taxable income and not get out of the 12% tax bracket. So that's where you really want to have a tax plan. I was just meeting with a client and talking to them about who does your tax planning. And almost inevitably, whenever that question is asked, they tell me the name of the person who's preparing their tax return. And I say, well, okay, so that person prepares your tax return. Do they help you with tax planning? And it was interesting because this guy's a business owner. He said, well, if I ask questions, they'll answer them for me. And I said, well, that sounds like planning, but it might not be. And maybe what you want to do, because you're in your 60s, is look at how you're going to dispose of the business and the real estate and the other assets and have a tax projection between now and the rest of your life so you know what it looks like. And that's in the context of that. That's when you decide, should it be a Roth 401k, should it be a Roth IRA? So you really want to be making these decisions in the context of your plan, not just making them in a vacuum. Because in a vacuum, any bald-headed person can get on the radio and say, that's stupid. You're stupid. You should have Roth. So anyway.
If you need some help, you need to reach out to your certified financial planner who's doing comprehensive financial planning. If you don't have one, if you just have someone that's giving investment advice or you don't have a relationship, by all means, you can contact us. We'd love to help. You can find us online, wisemoneyradio.com. Or if you're in the market for a CFP and you just want to look at your options, go to cfpnet.com, I believe. Search the CFP website. So, All right, let's dive into some listener questions here. We've got a few. I told you the first couple were texted in. Unfortunately, no names and locations here. So the first one that was texted in, here's the question: if we are retired and we've begun drawing Social Security, can we earn extra money on the side so that we can leave the rest of our retirement nest egg alone?
Yeah, the quick answer is yes, you can go earn a paycheck even after you've started drawing Social Security. However, there could be a trap here depending on how old you are.
Right.
So if you are under your full retirement age, and this is a different age depending on when you were born, somewhere between 65 and 67 these days. Most people it's 66 to 67, but prior generations it was earlier. If you are under full retirement age, then you are now limited on how much you can earn in paycheck money. And that dollar amount has gone up a little bit each year. It's $17,640 per year.
And I want to just tweak what Josh said a little bit. You are not limited on how much you can earn. You can earn an unlimited amount of money. The first $17,640 is not going to affect how your Social Security is taxed.
That's right.
But if you
No, you said that wrong. I'm going to tweak what Kevin is tweaking here.
I love it.
The first $17,640 is the limit on how much you can earn before the government will start chipping away at your Social Security benefits.
That's exactly what I said.
Penalizing it, not taxing it.
Okay, so let's make a simple and easy scenario. I'm retired, my wife's retired, we're 62, and we're both drawing Social Security. We earned, as a household, $27,640. So we earned exactly $10,000 above that limit. What the government's going to do is take back $1 for every $2 above that we earned. So they're going to take back $5,000 of
Your Social Security
your
benefit.
Social Security benefit. So I look at that, and people will say, well, then I shouldn't make that money, right? I'm like, no, make that money. You have that money. You have the money that you made. They're not taking back any of the money that you made. You have the money. Take the money. And if you think you're going to consistently earn well above the 17,640 limit, and you're 62 or 63 or 64, then you can actually stop your Social Security benefit. So I would keep that in mind. What we would encourage people to do is wait as long as you possibly can to start drawing Social Security. And what you want to know is the year that you turn, the year in which you reach full retirement age for Social Security, you want to be aware of that. And if you're beyond the year in which you turned full Social Security retirement age, you can earn an unlimited amount of money and have your Social Security be unimpacted.
That full retirement age that I was referring to is an important age because it changes, it takes away the limitations on your income earning ability. You can earn as much as you want starting full retirement age and beyond. So keep working. And don't start drawing your Social Security too early if you're going to still be earning high income, because they're going to chip away at that benefit. And the longer that you delay your Social Security benefits anyway, you're getting rewarded 8% a year for waiting.
Yeah. There's a couple things you need to be aware of. Is your Social Security taxable? And then is it penalized? Those are two different things. They sure feel like the same thing, but that's you need planning for that. And there's also just one other honorable mention: the year in which you start drawing your Social Security, if it's before your full retirement age, that annual income limit turns into a monthly income limit. So just be aware of that. Hey, what if you own a small business? You're running out of your house. At what level does it become taxable? When can you take that home office deduction? We've got that and more coming up here on Wise Money with Korhorn Financial Group. Sorry, that ran a little long. But I think there's a bit at the beginning we can cut out.
Dude, I had some good stuff that I had left on the table there. So are we done answering that question?
I think so.
Yeah.
We'll have that question again.
Well, the question that wasn't asked that I wanted to answer or just kind of add on to what Josh said was a lot of times when we have clients retire before full retirement age and they're just not sure. But because everything is kind of up in the air, they want to take control of something, so they run down and sign up for Social Security. And I would say, hey, make that the last thing that you do.
Yeah.
Because a lot of times people are saying, well, I might get called back into work for something. I'm considering some consulting projects. I have contacts in the business that have asked me to do stuff for them for years. And so just...
Okay, I just got pumped up. We are going to talk about this for just a second longer on the air. Okay?
Sweet.
And I might stick my foot in my mouth.
No,
It's never stopped me before.
I'm here to pump you up.
All right. Ready? Thank you so much for being with us today. This is Wise Money with Korhorn Financial Group, coming to you from the world headquarters of Korhorn Financial Group in the KFG studios. My name is Mike Bernard. Here with me, Kevin Korhorn and Josh Gregory. Do me a favor. If you are listening right now on podcast or on the YouTube channel, what I'd like you to do is subscribe to it if you haven't done so yet. Subscribe to it on YouTube. It's hit that little bell, that subscription, and that way every time there's a new episode that's posted or any other content that's posted, that it immediately goes to you and you say, yep, I'm completely up to speed and I can easily share this information with others. Same thing on the podcast. The feedback that we're getting, more and more people are listening to podcast and to the show on podcast. Thank you very much. But I know are lots of other people that are looking for wise financial habits. And so if you can subscribe to the show and then rate the show, that will help others find it as well. That helps us. You can catch up on all previous episodes right there, both of those ways, on the podcast. Wherever you listen to podcasts, search Wise Money with Korhorn Financial Group, or on the YouTube channel, just search Wise Money Show. And you can also catch up on every previous episode right there on the website, wisemoneyradio.com. All right, we are wrapping up a question that was texted in that said, hey, if I've already begun my Social Security, can I keep working, making extra money so I can leave my retirement nest egg alone? And we should be done with this, but I've got to get on a soapbox here. I was driving around in my car, and I'm listening to my favorite radio station, and I heard another financial professional on the air talking about how they can help you avoid the mistake so that you draw Social Security as soon as you possibly can and not waste hundreds of thousands of dollars. And guys, I almost drove my car off the road. I almost did. To me, just being, we've got this show. We are financial planners. We are not radio show people. But we have an outlet here, and I say that gives us a stewardship responsibility to give great guidance. And I heard this individual saying, well, that's exactly what the public wants to hear, even though it's a flat-out lie. That's what the public wants to hear, so they're going to spin that and say, that is the best thing for you, and see, I told you, so call us. Guys, that's a blatant mistake. What Kevin and Josh said earlier is, listen, if you're unsure about when to retire and whether you really will be satisfied being done with work, but you're done and you just think, well, I have to go draw Social Security, just wait. Just wait. Then sit down with your certified financial planner, make sure you're making the best decision, because each year that you do wait, that Social Security will grow for you, and it can be significantly higher over your lifetime. But that's not a blanket recommendation either. It's got to be based on your personal financial situation. Anything you guys would add in there?
Well, it's one of the biggest financial decisions you'll ever make in your lifetime, and the only way to know whether you made ultimately the right decision will be in hindsight.
Right.
You cannot know on your way into this decision whether it's the right one or not. So you have to get the right fact pattern, and make the best possible decision. And that's where we really encourage people. Listen, there are 10,000 baby boomers who are going to turn 65 today. There are a ton of baby boomers, and some of them are going to be seeking financial wisdom. There is a well-worn path to the door of certified financial planners who provide financial wisdom. So I would get my spot in line now and get the plan going. Get the plan going more than 3 months before you need to implement it, right? Get it going years in advance of when you need to implement it.
Okay, I want to get your opinion on another concept. It's all related to this same question. Because this person who texted in their question, they said, should we start our Social Security so that we can leave our retirement money alone? Or should we keep on working while drawing Social Security so we don't have to dip into our retirement assets? And that's an interesting question. A part of me thinks that it also has to do with what's going on in the markets or in your portfolio, because there may be a time when drawing Social Security early or continuing to work while drawing Social Security, maybe that allows you to postpone dipping into investments that happen to be at depressed levels at that time. So some of this has to do with just the timing of as you're approaching your retirement goal, what's going on around you, what's the context that you're making this decision in as well.
Yeah, and I would say what it has to do with is what you did 20 or 30 years earlier. Like we talked about the Roth IRA at the beginning of the show, having built in tax diversification into my portfolio where I can create the cocktail of retirement income that just absolutely maximizes my income tax situation and puts me in the best position to pay as much in taxes as I can at the lowest possible rate and possibly not have to draw Social Security.
Yep. So we need to move on. Does it matter? Here's the next question that was texted in. Does it matter how much I make from my sewing business for tax reporting purposes? In other words, is there a threshold that I need to exceed before I need to start counting this income on my taxes? That's a great question. It continues. And when I do start counting it, what can I write off? Finally, if I have a sewing room dedicated in my house to this side business, but I also use it for my own personal sewing, am I allowed to use a home office tax deduction? Whew. Lots of questions there. Great stuff. I hope we have time to pull the thread on this one and unravel it. What do you guys think? Yeah. Kevin, I just took
Kevinism.
I took the joke out of he's speechless because he was going to make some sort of reference there.
I was not, and you always needle me about that stuff, and I'm thinking, why is that?
Wow.
Okay. So, Joshy, do you want to start?
Well, it's interesting because often we get this question more on from a different perspective. Many times people start a hobby business that they start doing for friends and family. They start earning some income, and they often have more expenses than they have income coming in, and so they're actually on their tax return it would show up as a loss.
They actually want to say, no, this isn't a hobby. This is a business, and because they want the loss.
Exactly. But, the government's kind of on to that, and they really don't want you just perpetually showing a loss on your tax return because they're going to deem it to not be a true business that exists for the purpose of creating a profit.
And I don't have those exact rules right in front of me, but I think you've got to, if it's a side business, a side hustle, then you've got to show a tax profit within 3 years. And if it's an actual business you're running and you haven't shown a profit in those 3 years, then you kind of need to prove that, nope, this is a business that I'm running for profit, that and my intent is to make money. So I think that is probably the first question you need to ask yourself. Is this, you might be calling it a business and selling some things, but is this really a hobby? Mm-hmm. And that would be the first thing. If you're saying, no, it's a business, and I am making some money at it, then technically, you've got to report that. There isn't a threshold where it's like, well, once you make over 10 grand, you've got to report it. No, you've got to be reporting that. And then, like we've said, you then get to deduct your supplies and the other expenses related to you running that business.
Yeah, and one of the deductions or the write-offs that you're able to take is the one that was referenced here. It has to do with the business use of your home. And what a lot of people may or may not know is that you have the ability to carve out a certain portion of your house and dedicate it to a home office or some sort of assembly area, and as long as you use it exclusively for the business, then you can take a deduction on your tax return. So you basically calculate what portion of my home am I using, and based on that portion, you get to write off things like your utility bills and your real estate taxes and things like that.
And there is a simplified deduction where you can deduct 300 square feet at $5 a square foot. So talk to your tax planner and do planning.
You do, because you're using this same space for personal sewing, and to me, that means it's not eligible, but I'd want you to talk to your tax planner and the CPA who's preparing your taxes. Great questions. I hope that was helpful. Thank you so much for listening today. That's all the time we have for today. If you're, again, listening on YouTube or podcast, be sure to subscribe it, like it, share it, rate it, all that sort of stuff. Thanks, folks. On behalf of Josh Gregory, Kevin Korhorn, and the rest of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.